want to welcome you to our State of the Markets update for the first part of October 2025. We'll be walking through an update of the economics and the markets, and then also talk a little bit about the One Big Beautiful Bill and its implications for tax planning as we look at year-end tax planning for clients. So with that, we'll go ahead and dive in. The rates of return have been a bit surprising this year openly. Stocks in the U.S. and internationally have done well. Those fixed income investments have also done well relative to historical norms. So the stock market, you can tell, up in the United States, up about 14.5%. International stocks in the developed world up almost 26%, and then the emerging markets up about 28%. The difference there, the key driver between U.S. stocks and those overseas, has been currency movements. When we look at the actual profitability numbers, when we look at the markets within their own currencies, you'd see that those numbers haven't deviated too much between the U.S. and international and emerging market stocks. But the currency movement with the U.S. dollar depreciating against the pound, the euro, and the yen has been the key driver there. In essence, it's a great time to be a U.S. investor of international stocks. It's not a great time to be a U.S. traveler to those countries and be purchasing their goods and services there because it's more expensive relative to the U.S. dollar. When we look at the bond side of things, at a big picture, the U.S. aggregate fixed income up about 6%. That's the entire U.S. bond market. When we look at just treasuries, up about 5.5%. Municipals only up about 2.5%. The key driver there and the differential, of course, this year has been the issuance of a higher level of issuance of U.S. municipal bonds. And so those municipalities this year, as opposed to former years, have had greater issuance, which has, anytime, of course, you have a greater level of supply and you don't have any more demand, then the price ends up being impacted in that and moving down. So we look at that, and overall, with the price moving down a little bit, that's impacted those rates of return. Finally, global reinsurance up almost 9%. So that would be those reinsurance investments globally have not had nearly as many hurricanes that have hit with force, say, on the U.S. seaboard, eastern seaboard, or wildfires in California. Those kinds of things have been fairly moderate compared to former years. So fairly strong returns there through the first three quarters. If we look at the third quarter in particular, the U.S. stock market up about 8%, international stocks only up about 5.5%, and then the emerging markets up about 11%. Again, the key driver here in the difference between international and, say, the emerging markets has been some differences there in currency with the U.S. dollar. But the dollar, in large part, had its depreciation against the euro, the yen, and the pound in the first half of the year. Not as much movement here over the third quarter. The U.S. stock market has gone up, of course, in the third quarter, driven in large part by growth and technology stocks. We'll talk about that here in just a moment. But third quarter, again, some really solid returns after kind of some average type returns in the U.S. in the first half of the year. Those have really accelerated here in the third quarter. When we look at the bond side of things, again, steady performance of about 2%. Overall, U.S. aggregate bonds, 1.5% for treasuries. Municipal bonds were actually underwater at the midpoint for the year. They've been up about 3% so far this last quarter. And then global reinsurance, again, up about 6%. Reinsurance did okay in the first half of the year, again, up about 3%, but really had a nice third quarter as we had very few hurricanes come through, and those reinsurance payments are higher in the third quarter with the likelihood of hurricanes emerging there when we look at history. When we drill down into what's happened in the U.S. stock market, first 9 months of the year, again, U.S. stocks up about 14.5% overall. Large cap companies, those larger firms from a market capitalization standpoint, have outpaced the smaller firms by about 4% so far this year. Likewise, growth has outpaced value by about 5.5% so far this year. Hard to say where that's going to go in the fourth quarter, but that has been the trend so far this year and really aligns with what's happened over the last 10 years, although that's different in both cases than what we've seen, say, over the last 100 years or so on average. If we look at the equity returns in the third quarter in particular, you could tell, again, large cap companies up about 8%, small cap up about 12.5%. So smaller companies did really well in that third quarter. Value companies didn't do as well as their growth counterparts. So really it was that small growth that did the best of all of those types of investments or all of those arenas. The large value companies did the poorest of those particular focus points. If we look at the international developed side of things, the large cap companies up about 25%. Their smaller cap counterparts up even more, up a little north of 30%. And this is where that diversification helps. Oftentimes, we'll see value outpace growth in one arena or another, but maybe not do that across all geographies. And that was the case in the third quarter and the case over the first 9 months of the year. You can tell large value outpacing large growth by a pretty wide margin there, about 14% over the first 9 months of the year. When we look at the third quarter, that trend was pronounced as well. Large value internationally outpacing large growth by about 6%. And again, small cap companies internationally outpacing their larger counterparts. If we look and drill down a little bit more, first 9 months of the year on the bond side of things, again, we've talked about how the aggregate bond market up about 6% and treasuries up about 5.5%. The Treasury inflation protected securities were up even a bit more, up almost 7%. And that's because when we look at Treasury inflation protected securities, there is a component there dealing with inflation. And if inflation expectations increase, then those bonds respond positively. So TIPS have been better performers than overall U.S. Treasuries. When we look at shorter term Treasuries up about 4%, those are going to be less sensitive to movements in interest rates typically. So they've done haven't done quite as well as Treasuries in general. The longer dated Treasuries have been kind of in line with the average. What we don't have here actually breaking out is those intermediate Treasuries, which have led the way. So the yield curve has come down, pushing those bond prices up the most in the 2 to 10 year range. And so that's pushed up those intermediate Treasuries. So they've actually had an average rate of return that's been above 5.5% so far this year. If we look at high yield corporate bonds, those would be bonds that are issued by companies that their credit quality isn't quite as good as the investment grade corporates, which are right next door. So those high yield corporates have been up about 7.2%. They pay a higher yield, but they also have a higher potential for default. So oftentimes if markets are in order and reasonably well run and there's not some kind of a recession or something like that, then we'll see a higher rate of return with high yield. And we see that a little bit than U.S. corporates, but not all that much. Corporate bonds, of course, up almost 7% as well. They're typically going to give a better rate of return than we would find with treasuries, again, provided that we're not in some kind of a recessionary environment. As I mentioned, municipals up about 2.5% and global reinsurance up a little bit less than 9% in the first 9 months of the year. When we look at the third quarter numbers and we drill in there, tell again, aggregate bonds up about 2%, U.S. treasuries up 1.5%, TIPS again up a little over 2%. The shorter dated treasuries up a little bit less than the longer dated treasuries. And then again, high yield corporates and overall corporates up a little bit more than their treasury counterparts. As I mentioned, municipals up about 3%. So kind of recovering some after the difficult first half of the year. And then again, global reinsurance up about 6%, driven in large part by higher levels of premiums being paid in that third quarter and fewer claims coming against those reinsurers based on just a lower level of natural catastrophe than what we would say would be typical for this time of year. So in summary, we kind of think about what's happened over the first 9 months of the year. We've been a bit surprised just by the growth in and performance of the stock market. Haven't seen tremendous growth in profitability. We had a stock market coming into this year that's a bit expensive, and the rates of return have been above average. You know, if we think about the United States stock market over the last couple hundred years, an average rate of return somewhere between 9 and 10%. We've seen a rate of return across the entire market on average of 14.5% so far this year. So above trend returns, from a starting point that was already a bit expensive. So a little surprising there. On the other hand, international and emerging market stocks, they've been driven by the tailwind of a depreciating US dollar. So they also didn't come in quite as expensive to this year. And so their performance hasn't been quite as surprising. We did expect at some point for a depreciation of the US dollar, just given some of the different dynamics of the trade deficit that we've run, as well as the amount of money that our government is printing. Those both tend to depreciate the value of a currency for a country if those trends are in place. On the fixed income side, again, a rate of return that's a little bit above trend, just simply because we've seen interest rates come down, pushing bond prices up. So whereas last year, the aggregate bond index for the year in 2024 was up about 2%, so far we've seen a rate of return that's more like 6%. Really, interest rates haven't changed that much, but if we have a core interest being paid out that might be something like 5%, if we look at US and corporate bonds together, when we have an environment like last year where interest rates were rising a little bit, the total return is going to be less. So it was about 2% last year. This year, we've seen the opposite. We've seen interest rates drop a bit, pushing bond prices up. And so if that holds, then we'll see rates of return above trend, might end up being 7, 8, 9% this year if trends hold. So with that, I want to turn things over to Austin, who will be talking about the One Big Beautiful Bill.
Thanks, Spencer. Yeah, so in a lot of this with the One Big Beautiful Bill, there are some changes, and a lot of those changes for our client base is going to affect folks that are in that 65 and older space. Some things have changed with Roth conversions, even as we think about that. So with the One Big Beautiful Bill, there are lots of things that we could get into, but really we're going to try to focus on what are those key issues that our clients have asked us about with the One Big Beautiful Bill. So there's going to be three primary considerations that we're going to cover today. The first really is federal fiscal health and historical tax rates. We're going to look both at where taxes are currently and where they have been in the past to kind of give us some guidance of maybe where the future might hold. With the One Big Beautiful Bill, the Tax Cuts and Jobs Act rates were extended in perpetuity. Obviously, it's not actually an in perpetuity permanent change. As Congress and the Senate and the White House turn over in decades to come, they can always change tax rates later. So we know that these are permanent for now, but that doesn't mean perpetually permanent. So we want to look back at history and see, okay, how does that affect our planning? We're going to talk about the enhanced senior deduction. So when President Trump was running for office, he tried to promise that he would eliminate tax on Social Security. It was a little bit more challenging to do so. So in the One Big Beautiful Bill between now and the next election cycle in 2028, when the calendar year 2028 ends, there is an enhanced senior deduction. And so we'll talk about that and how that affects tax rates. And then finally, we'll discuss how does this all relate to the beloved Roth conversion and how you need to think about this. So we'll start off with looking at the US government surplus or deficit as a percentage of real GDP. So we only have data for this between until the end of the calendar year of 2023. The data has not been reported for 2024, and obviously we are not yet at the end of 2025 to have those numbers. But as we're sitting, the deficit, the government deficit was sitting at about $1.7 trillion at that point in time. And the deficit as a percentage of GDP was about negative 7%, which is a really substantial place. So if you look at the graph there, what you're seeing is, between 1970 and really the beginning of the 2000s, we were hovering in that space between 0 and negative 4% of deficit to GDP. That's where many economists would say is a healthy place to stay. There was a period there in the early 2000s where we were actually in a surplus relative to our deficit or relative to GDP. And so if our 4% is that target, what you would see now is we have substantially gone below that. There was that period during COVID where we were trying to stimulate the economy and funds were being pushed out, and that increased the deficits in those years. We've pulled it back a little bit, but we're still at an incredible deficit of nearly $2 trillion. What we would say is it's not purely that number of $2 trillion that's alarming, but the alarming nature is that the deficit relative to the GDP is at a place that really is unsustainable for long-term growth of the economy. And so when we think about this, we know that this is problematic as well as our spending is problematic. So we've got income that's not coming in to cover our bills. We've got high interest payments on the debt that we have issued because interest rates have risen. And we would say there is a little bit of recency bias that our minds have of, well, can't we just go back to the interest rates that we were having in the early 2000s or the mid 2000s, in the early 2010s, where interest rates may have been in that 3% range for mortgages and interest on our savings accounts wasn't paying a whole lot. But if we look towards history, we're kind of actually in an average interest rate environment. And so we've got high interest rates, we've got high expenses, and then we pair that with tax revenues that maybe not as rich as they have been historically. And so if we look at over the last 80 years, back since 1940, this is a chart of the minimum and maximum marginal tax rates for married filing joint year by year. And so in 2025, you can see on the right side of the chart where those marginal rates are at 10%, 12%, 22, 24, 32, 35, and that top bracket being 37%, as well as what those income rates would be where you would enter into that next marginal bracket. And you can really see where we're sitting and where we've sat really for the last about 20 years has been a lot less expensive at the top rates than they have been historically. Now, even if we look back to the 1940s and 50s, and even in the early 60s, where those top rates were in that 90%, the amount of individuals that paid tax in that top percent was actually a very small rate. Most people pay in those lower brackets, and there's a very small percentage of folks that pay in that top bracket. But the ones that do pay in that top bracket pay a substantial amount of tax. And so what we're looking at here is our tax brackets again on the left side of the screen, and then the percent of tax returns filed. And so even at that top bracket, you're only having 1% of people pay within that bracket. But if we look at the chart on the right side, the percent of total tax generated by that bracket is almost a third of the total revenue generated from income taxes filed. And so really what we're thinking about here in broad perspective is a majority of the income tax that's generated right now is by those higher income earners. You look at, if we've got between the 22% bracket and below, a majority of taxes are filed in those brackets. You have about 10% that's in the 24, 32, 35, and 37. And so you have 90% of your tax returns are filed in the 22% and below, generating only about 30% of the revenue. So I hate to be the bearer of bad news, but the reality is if we're going to deal with a increasing and ballooning deficit and tax rates that you can't just tax the rich more and generate more revenue off of them, there really needs to be a leveling of the playing field where a tax burden is shared kind of across the population. And so we're entering this space where we have historically low tax rates, we have a ballooning deficit, and so we've got fiscal problems on the horizon that we really need to start thinking about creative ways to deal with this. We're not going to get into how we think this should be done, but this is just the data that is being shown. And this is based on 2022, where those rates are and where filers are. And so really we've got issues both on the spending side, but we've got issues on the income side from tax revenues. And so what we want to start thinking about now is how do we do creative tax planning? We want to do good tax planning for folks that have that enhanced senior deduction. So what is the enhanced senior deduction, you might ask? So if you are 65 years or older in the calendar year 2025, 6, 7, and 8, and you have a modified adjusted gross income for individual filers under $75,000, and for married filing jointly, it's under $150,000. So your base standard deduction is going to be for any individual filer, it's going to be $15,750. If you are over 65 years old, you get an additional $2,000 deduction. And then regardless of whether you file the standard deduction or itemize your deductions, if you have less than $75,000 of adjusted gross income, modified adjusted gross income, you will receive a $6,000 enhanced senior deduction. Again, this is only if you are older than 65 years old. So that brings your total standard deduction to $23,750. Now, what happens is once you cross the $75,000 threshold, every dollar that is brought in, or as you increase dollars, there is a percentage reduction of that enhanced senior deduction. And so essentially you're being taxed at a higher rate than your marginal bracket. And so that enhanced senior deduction is phased out between the next $100,000. So between $75,000 and $175,000 for single filers. For married filing jointly, it's between $150,000 and $250,000. So we'll see what happens to your actual effective tax. So this isn't your marginal tax bracket. This is your effective tax. And so we see before, as you're in that about $60,000 range, you're still in the 12% tax bracket. And then you jump to the 22. But then as you start layering on the loss of the enhanced senior deduction, if you are a single filer, you start off with that 22% marginal rate, but then it's about a 1.3% loss for the next $1,000 of ordinary income. So your effective tax essentially goes from 22 to 23.3%. And then there's even a crossing point once you cross about $125,000, where you're entering that 24% bracket of marginal rate for a single filer, to where then your effective rate jumps up almost over 25, it jumps up to 25.4% essentially. And so you're adding tax at a higher effective rate than what you would be paying on a marginal rate to begin with. So really for folks that are in that $75,000 to $175,000, if we can keep you below $75,000 of modified adjusted gross income, whether that's taking distributions from Roth IRAs, whether it's deferring a IRA distribution until later, if you've got cash resources to live on, if you can, maybe we've been planning for doing Roth conversions and now we're saying, hey, it made sense at your previous marginal tax rate. Well, now if you're being taxed at 25%, we've got to really think critically on what your future tax implications may be. Again, like we said earlier, we've got a deficit problem. We've got an income problem. And so we know that the likelihood that taxes increase at some point in the future is probable, but we don't know when those tax increases might come. We know that they're definitely going to be set for the next couple of years. And so from a tax planning perspective, we want to say, hey, if we can keep you at that 22% or 12% level and not lose that enhanced senior deduction, that's a really nice benefit that you're adding. As we look on this on a married filing jointly perspective, again, you're at that 12 and 22%, those marginal rates. But then once you get to you start reducing the enhanced senior deduction. This is presuming that both of the individuals are over the age of 65. You jump from 22% to a 24.6% effective tax rate. And then there at the very tail end, when you're in that $245,000, $250,000 of modified adjusted gross income range, you're also layering in up to 26.6%. And then you've also got the dreaded IRMA surcharges. And so there is even some more Medicare surcharges that would be imposed that could even bring that tax rate up a little higher to almost 30%. And so really the enhanced senior deduction changed a lot of our tax planning for folks that are both on Medicare and receiving that enhanced senior deduction. And so clients, talk with us if you've got questions about this. This really created some complexities for both tax planning on Roth conversions, but even for some folks that are doing donor advised fund contributions and how do we think about charitable giving? Because sometimes what we would consider is, hey, how do we do a maximized Roth conversion for you to get up to certain tax brackets or certain surcharge thresholds, but offset it with donor advised fund gifts? And these have just become more expensive with that enhanced senior deduction. And so really want to consider that as we do tax planning for our clients. So as we think about Roth conversions, we always bring up these questions. And especially this pertains to folks that are 65 and older, but even for everybody through 2028. We want to think about what is your current tax bracket. If you are in the 10 or 12% bracket, then Roth conversions might make sense, but they might not. if it causes you to start losing that enhanced senior deduction and it causes your tax rate to jump up to 23, 24, or 25%, okay, now we really got to start thinking. We also have to always ask with a Roth conversion, what do you anticipate your future tax bracket to be? We think about the future known tax bracket. So we know if a client is 70 right now, that in a couple of years, they're going to start their required minimum distributions. If they're not planning to make qualified charitable distributions, well, if they're in a 22% bracket now, but they're going to jump to 24 or 32 or even 35% later, okay, well, let's start really thinking about Roth conversions in that scenario. If we can pay lower tax now than our known rate in the future, then it can make sense to do a Roth conversion. And I think the one thing that we always come back to with clients is, do you plan to make charitable contributions from your pre-tax resources from your traditional IRAs via a qualified charitable distribution? If you know that, yes, I plan to go into the 22% bracket, but if that is based on all of that income being taxable, and you actually are planning to do high levels of QCD to where maybe you're in the 12% bracket now, and your future expected bracket with those qualified charitable distributions keep you in the 12% bracket, well, then we don't necessarily want to convert into the 22% bracket if your known future tax rate is 12%. There's a lot of nuance here, again, because as we talked about earlier, we're running a massive deficit. We need to generate more income. And so tax rates, likely, whether it is the income tax rates or some other combination of other taxes, will probably increase at some point to deal with this deficit. But we know the short term is what we have as a known factor. And so we're trying to plan as best we can with what is a known quantity, not an unknown quantity in the future. But looking out at the projections from the Office of Budget and Management and things into the future, we know that this fiscal problem is going to continue and to grow. And so there has to be some changes that are made. And so we want to take this with prudence and wisdom, saying we don't know exactly what will happen in the future. If rates of return are foggy projections, then tax planning is also going to be a foggy projection. And so we want to say, take everything that we're saying with a grain of salt. We're not CPAs, but we're saying, hey, how do we be wise with all of our tax planning, both for now and for the future? So with that, we'll always say all of our advisory services are offered through Retirement Planning Services, LLC. Past performance does not indicate future results. Indices are not unmanaged and cannot be invested into directly. So clients, if you've got questions about anything with the One Big Beautiful Bill, with rates of return, with how your investments are performing relative to the benchmarks, we would love to have those conversations with you. And until we see you next time, take care.
If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.